Gold surged $311 in a single trading session today, marking the most substantial one-day dollar increase witnessed since 2008. This represents approximately $2 trillion shifting hands within one session, comparable to Amazon's complete market capitalization. There was no CEO announcement, no quarterly earnings report, no board meeting convened, simply the world's most ancient form of money asserting its continued relevance. Gold climbed 6% today, translating to $286 per ounce, while silver jumped 14%. When gold, silver, and copper all rally simultaneously, this isn't mere speculation. The system is fundamentally reassessing what constitutes actual money. Jesse Livermore described this phenomenon as the market communicating vital information. Intelligent capital pays attention before questioning the underlying reasons. However, there's a crucial connection most people are missing. Physical silver has become extraordinarily difficult to acquire at present. Bullion Star recently announced that the physical market is experiencing significant strain. Silver, particularly, is nearly impossible to obtain. Minting facilities have shuttered operations, refining operations face massive backlogs, and most competitive dealers report depleted inventories. They maintain stock because of forward planning. Nevertheless, premium pricing will adjust to mirror genuine physical market realities. They've reduced minimum transaction requirements from 20,000 Singapore dollars down to $10,000 and will maintain ongoing assessment. Physical metal accessibility becomes critical, particularly during periods like these. In my previous video yesterday, I discussed the potential for price movement toward the $87 to $90 zone. What makes that particular area significant? At that moment, trading occurred around 80, and that level constituted a crucial convergence of technical elements. We didn't reach it yesterday, but today's price action touched that zone before experiencing rejection. I cannot completely explain why that specific area carried such importance here. That analysis deserves an entirely separate video presentation. But this represents our channel's methodology. We scrutinize both potential scenarios using legitimate data. No sensationalism, no greed-driven predictions, no fear-mongering. Simply authentic technical analysis coupled with sound strategic planning. If this content provides value to you, please subscribe and leave a comment so I understand the genuine community is engaged. Remember, approximately 70% of viewers on this channel are long-term precious metals investors, decade-long accumulation strategists. Some participants are short-term position traders. That's precisely why we occasionally address both perspectives, the physical metal reality and the paper futures market dynamics. Regardless of your particular approach, the objective remains identical: to formulate plans, not to engage in gambling. Currently, during this recording, silver Western spot and futures trade at $85. Shanghai spot reaches 100. Shanghai futures stand at 101, resulting in a Shanghai premium of $15, representing an 18% premium. Several days ago, I published a video analyzing a critical technical threshold. If price action closed beneath the 150 exponential moving average on the hourly time frame, while we traded above $100, we could potentially witness the early 90s as viable support. The price initially rebounded precisely as our analysis suggested. Then, I released a follow-up video regarding the Federal Reserve Chair's potential market impact, explaining how it might drive us even lower, potentially beneath $86. For numerous channel viewers, that analytical perspective proved extremely valuable. Let me state this with absolute clarity. It wasn't a trading signal. It represented a scenario requiring strategic preparation, and as we observed, it materialized. Now, here's the critical technical level requiring everyone's understanding. The 150 EMA on the hourly chart, which we utilized for the 86 and below projection, currently sits at $96. And following this 18 to 20% rebound in silver from its lowest points, I'm encountering people declaring this a definitive bottom. I cannot confirm whether it is. I don't attempt to identify bottoms or tops. And I'll declare it emphatically, nobody does successfully. It's amusing witnessing some imitators even claiming they possess insider connections, with thousands monitoring their content. At this stage, it's more entertainment-focused than legitimate analysis. Here's what the technical framework is communicating to us. A complete washout of contract open interest typically correlates with market bottoms. With February 26 concluded and entering delivery phase, insufficient roll activity plus forced liquidations reduced total COMEX gold open interest to merely 414,756 contracts on Monday. That's the lowest aggregate total since June 9, 2025. Additionally, note the open interest decline in COMEX silver. As of Monday, it dropped to 142,368 contracts. That's the lowest total open interest recorded since May 20, 2025. Open interest reaching multi-month minimums typically signals capitulation. Weak-handed participants eliminated, leveraged long positions liquidated. But the 150-hour EMA currently resides at 96, functioning as resistance rather than support. We're positioned at 85, $11 beneath that pivotal level, the 87 to 90 target I projected. We achieved it and experienced rejection. That rejection carries significance. It demonstrates resistance exists there. Bulls attempted pushing through, couldn't maintain positions, got forced back downward. Let's examine both perspectives. Bearish scenario first. The 150-hour EMA at 96 represents a downward sloping resistance barrier. When support transforms into resistance, that's a bearish reversal. We tested 87 to 90, got rejected, retreated to 85. If we cannot recapture 90 and sustain it, the subsequent test could trend lower, potentially retesting the 71 low. Bitcoin declined below 74,000 for the first occurrence since April 2025. Risk-off sentiment is spreading. S&P 500 closed down 0.8%. Nasdaq declined 1.5%. Wall Street's Fear and Greed Index stands at 39. We've returned to fear territory. Global bond yields are spiking dramatically. German 30-year bond yields climbed to the highest level since 2011. U.S. 10-year Treasury yields are approaching the highest level since August 2025. Japanese 10-year yields near the highest since 1999. This represents systemic stress. When bond yields spike globally, everything else sells initially, including metals, and there's escalating geopolitical risk. Reports of U.S. military engagement with Iran dominating headlines. If accurate, that's a major catalyst. But initial reaction to warfare is often risk-off. Sell everything, raise cash reserves, wait for clarity. Only afterward does the safe haven buying commence. So if geopolitics deteriorate further, we could witness additional volatility before sustained rallying. That's the bearish scenario. The 150-hour EMA at 96 represents resistance. Rejection at 87 to 90. Risk-off sentiment prevailing. Bond yields spiking. Bitcoin breaking down. More downside remains possible. But here's the bullish scenario. Physical silver is nearly impossible to source currently. Mints shuttered, refineries severely backlogged, competitors completely empty. Bullion Star had to reduce minimums from 20,000 to 10,000 just to preserve access. This isn't paper market volatility. This is physical scarcity. You cannot fabricate closed minting facilities and empty refineries. When physical metal is this constrained and paper trades at 85, the disconnect is extreme. Central bank gold demand remains extraordinarily robust. Central banks purchased 328 tons of gold in 2025, just below the 345 tons acquired in 2024. Poland led purchases with 102 tons, followed by Kazakhstan with 57 tons. Gold acquisitions by central banks have continued for 33 consecutive months, 33 straight months of continuous buying. The 12-month moving average stands at a massive 27 tons. The central bank gold purchasing supercycle shows no indication of slowing, regardless of price fluctuations. David Hunter raises gold price projections from 5,500 to 6,800, raises silver price targets from 125 to 180. That's a credible analyst increasing targets while everyone else capitulates in panic. COMEX open interest at multi-month lows, lowest since May for silver, June for gold, washout complete. When open interest collapses like this, bottoms typically form, not always immediately, but the forced selling is finished. The weak hands are eliminated. The leveraged longs are liquidated. Gold pricing during Germany's hyperinflation from 1914 to 1923 witnessed gold prices increase 1 billion times. Monthly volatility ranged from negative 30% to plus 160%. Even with perfect foresight, one would have experienced gut-wrenching volatility. This is normal in precious metals bull markets during currency crises. The volatility isn't the fundamental problem. It's part of the process. Fundamentally, the gold bull era is 100% intact. The narrative being promoted by mainstream media suggests that because a new Fed boss will supposedly maintain decision-making independence from U.S. government influence, gold needed to decline $1,200 per ounce, and silver needed to fall $50. In essence, the story being promoted is 100% nonsense. 3 billion gold-obsessed citizens of China and India, and a small group of savvy Western gold enthusiasts, don't need central banks because their focus centers on building glorious savings in gold, rather than accumulating more fiat currency and debt. In the broader picture, the bull market thesis doesn't depend on who manages the Fed. It depends on whether the underlying fundamentals, debt levels, currency debasement, physical supply-demand dynamics remain intact. And nothing in those fundamentals has changed. The 5,600 area in gold and the $70 area in silver have historical significance as previous support levels. The silver crash was amplified by leveraged positions getting liquidated, which is typical in volatile bull markets. Gold bottomed around 4,400, while silver found support around 70. Whether those levels hold long-term requires more data and price action to confirm. Chinese yuan hits strongest level against the US dollar since May 2023. Yuan strengthening while dollar weakens. This supports higher gold and silver prices in dollar terms. The pricing power is shifting eastward. China accumulating. Central banks buying 33 months consecutively. Physical impossible to source. Mints closed. Refineries backlogged. And paper trades at 85. So is 71 the bottom? Here's what I'm monitoring. If we reclaim 90 and hold above the 150-hour EMA at 96, that's bullish confirmation. The bottom is established and we're heading higher. If we fail to reclaim 90 and start testing 80 or below, more downside is approaching. The 87 to 90 rejection matters significantly. Bulls couldn't hold it. That's a warning. But physical scarcity and central bank buying suggest the fundamentals are overwhelming the paper manipulation. Current prices: Western Spot 85, Shanghai 100, $15 premium representing 18%. After a 40% crash, the premium is compressing but remains elevated. Physical is still trading above paper. Mints are still closed. Refineries are still backlogged. Open interest is at multi-month lows. Gold just posted its largest one-day gain since 2008. These are not normal market conditions. So, where does this position us? Number 1. I projected 87 to 90 in my previous video. We hit that target and got rejected. We're back at 85. The 150-hour EMA is now at 96. That's resistance, not support. We're $11 below it. Is 71 the bottom? Drop your thoughts in the comments. We need more data. Number 2. Physical silver is near impossible to source. Mints closed, refineries backlogged, dealers lowering minimums just to maintain access. Central banks buying 33 straight months. COMEX open interest at multi-month lows. David Hunter raising targets to 6,800 gold, 180 silver. These are bottom signals. Number 3. Gold moved $311 today. Largest one-day gain since 2008. Silver up 14%, but Bitcoin's below 74,000. Bond yields spiking globally. War with Iran escalating. The volatility is extreme, but that's normal in currency crisis bull markets. The unresolved tension. Physical impossible to source. Central banks buying relentlessly. COMEX washout complete. But we got rejected at 87 to 90 and now sit at 85, with resistance overhead at 96. Is this the bottom, or do we test lower first? You tell me. Is this where we turn, Or is more pain coming before the rally resumes? Do your own due diligence. Understand the risks. The technical picture is mixed. Rejection at 87 to 90 is bearish. Open interest washout and physical scarcity are bullish. The 150-hour EMA at 96 is key resistance. We're below it. If we reclaim it, bullish. If we fail, bearish. The physical market says the bottom is close or already in. The paper market says more volatility is possible. But here's what matters most. This is war-driven price action. Geopolitical events are unpredictable. Headlines can reverse in hours. What looks like a breakout today could be a bull trap tomorrow. Leverage kills in markets like this. Even physical holders need to understand that premiums can collapse as fast as they spike. Nothing is guaranteed. Not the bottom, not the bounce, not the breakout. Now, if you're a long-term stacker with a time frame of years or decades, this is noise. Daily swings, hourly charts, EMA tests, none of it matters if your thesis is monetary debasement, industrial demand growth, and central bank accumulation over the next 5 to 10 years. For stackers, the only question is, can you source metal? And is the premium reasonable? Everything else is just volatility you ignore. But if you're trading, if you're using leverage, if you're playing short-term moves, then every level matters. Know which signals you're following. Know your risk tolerance. Know what you can afford to lose. And if you're using leverage or trading derivatives, understand that this volatility can wipe out accounts before you have time to react. Plan for the worst, hope for the best, but never ever assume you know what happens next. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.